What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over the 3 big reasons that you should consider buying Urbn Outfitters stocks right now according to this article by Investors Place. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and will be conducting my own quantitative analysis to see whether Urbn Outfitters stocks either belongs in our dividend portfolio or our value portfolio by using this checklist. So if you guys feel like being amazing and awesome and hope this video has provided you a lot of value, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And now, without a further ado, let's get this video started. So 3 big reasons to stick with the rally in Urbn Outfitters stock. Urbn stock is proving itself as the best mall retailer in the world by Luke Lango, Investor Place Markets Analyst. Struggling mall apparel retailer Urbn Outfitters, Urbn, reported surprisingly strong second quarter numbers that smashed depressed expectations. Urbn stock popped on the news in late August. Comparable sales dropped just 13% in the quarter versus a 28% drop in the first quarter. Comparable sales at the Free People brand actually rose 11%. Gross margins rebounded from 2% in quarter 1 and to 29% in quarter 2. The SG&A rate fell almost 400 basis points. I don't know exactly what that means, but operating margins expanded in the quarter. Management commented on the conference call that August sales and traffic trends are steadily improving relative to July and second quarter. All in all, it was a solid quarter, which broadly underscored that Urbn Outfitters is in the rebound mode. According to Urbn Outfitters stock is also in rebound mode. Coming into the earnings report, shares were trading down about 30% for the year. And the heels of Q2 earnings, Urbn Outfitters stock has surged more than 20% higher. I think you stick with this rally for 3 reasons. Urbn Outfitters is the cream of the crop in mall apparel retail, and the company's strong performance in the quarter enabled management to advance strategic growth initiatives at the same time that peers are struggling to stay afloat. Consumer spending on discretionary items like apparel will continue to recover over the next few months, providing a tailwind for Urbn already improving sales trends. Thanks to recovering sales trends and rebounding margins, Urbn Outfitters stock remains cheaply valued even after its post-earnings surge. Urbn Outfitters stock, cream of the crop in mall retail sector. In long held the belief that Urbn Outfitters is the best in the business when it comes to mall retailers, the company is supported by 3 brands with strong brand equity: Urbn Outfitters, Free People, and Anthropology, all 3 of which make their own line of exclusive trend-forward clothes that strongly appeal to young consumers. The store presentations are very relevant and hip. Urbn also has one of the strongest and most robust digital business in the mall retail. All in all, Urbn Outfitters is a top-notch retailer. Second quarter earnings confirm that. While everyone else is in this space is dealing with a 20% plus comparable sales drop, eroding margins, and a huge cash burn, Urbn Outfitters saw comparable sales fall just 13%, profit margins expanded, and the company actually printed a profit in the quarter. Because of the company's outperformance during the crisis, management has the resources to push forward on its strategic growth initiatives during these unusual times, such as paying down debt, buying back shares, opening new stores, healthily clearing inventory, and optimizing omni-channel capabilities. By comparison, all of Urbn peers are barely staying afloat. The implication, of course, is that existing the CVPD crisis in 2021-2022, Urbn Outfitters will be in a far better position than everyone else in the space. The company growth trajectory could actually accelerate because many of its peers will likely go under, giving Urbn a compelling opportunity to expand market share in 2021 and 2022. So what the writer here is saying is that, hey, we don't know how the CVPD or the current economic situation might last, even if the crisis does progress to 2021 and 2022. Because of its management and its dominance that it has on this mall sector, it should be able to survive when compared to its competitors, right? Rebounding consumer spending. Management commented on the conference call that August sales trends are improving related to July and the second quarter, an improvement that should persist for the foreseeable future. The reality is that America is finally mastering the CVPD balancing act, where we sustain economic normalcy and keep virus risk mitigated by doing things like moving retail stores outside, converting curbside parking into outdoor restaurant seating, and repurposing parking lots and streets into open-air markets. As these smart preventive actions have been adopted broadly, we've seen consumer spending rebound over the past few months, and we've seen CVPD cases drop. It is a best of both worlds scenario. Consumers, business, and legislators alike will only get better at this balancing act over the next few months. As they do, current trends will persist. Consumer spending will continue to rebound. CVPD cases will continue to drop. Importantly, that means Urban Outfitters' comparable sales trends will continue to improve towards pre-CVPD levels over the next few quarters. So Urban Outfitters stock remains cheap. Despite the 20% post-earnings pop, Urban Outfitters still remains cheap. Prior to earnings, my model on Urban Outfitters called for sales to rebound sharply in 2021 and then grow at a steady 3 to 4% compounding annual growth rate thereafter into 2025. I also modeled for gross margins to recover somewhat, but not entirely, and for SG&A deleverage to a headwind. Urban's second quarter earnings broadly confirmed that my top-line assumptions for the company are reasonable. However, earnings also implied that, thanks to rent negotiations wherein Urban Outfitters is seeing some success, is talking down rent costs. Gross margins will be able to expand to above pre-CVPD levels within the next few quarters. At the same time, the earnings report also implied that Urban Outfitters is learning how to sell a lot of product on a slimmed down OPEC space, and that SG&A leverage will be a tailwind going forward. Because of that, and factoring in newly announced share buyback program, I'm upping my 2025 earnings per share estimate on Urban Outfitters from $2 to $3. Overall, the past 5 years, the market forward earnings multiple has averaged around 17 times. Earnings based on that average multiplied and a 10% discount, $3 in 2025 earnings per share implies a 2020 price target of Urban Outfitters of roughly around $35. So this analyst is estimating, or this writer is estimating, that the stock price could be somewhere around $35 with its current valuations. The bottom line on Urban Outfitters stock. Urban Outfitters is proving to the market that it's not just another struggling mall retailer. This is the best retailer in the mall world. Urban Outfitters stock is consequently rebounding. This rebound will persist because the fundamentals are solid, growth trends are favorable, and the valuations remain discounted. Okay, let's have a look at the price to earnings multiple for Urban Outfitters. Urbn. That's interesting. It seems that it doesn't have a positive price to earn, like positive earnings. As a result, it doesn't have a current price to earnings multiple at the moment. Okay, in order for Urban Outfitters to meet our dividend portfolio, it basically needs to meet 4 rules. My dividend portfolio principles are based on these 3 books that I read. The first book is Dividends Still Don't Lie by Kelly Wright. They run their own website called Investment Quality Trends, or IQ Trends. Highly recommended. The second book is Get Rich with Dividends by Mark. And the third book is The Ultimate Dividend Playbook by Josh Peters, who is an editor at Morningstar. And the 4 principles are as follows. So rule number 1 is that the current free cash flows must be positive. So the free cash flows are the physical cash that the company is able to generate after paying out all of its capital expenditures. So you want to be investing in companies that have a positive cash flow so that you can sleep well at night, so that you know that your money is working for you. And rule number 2 is that the dividends that are being paid out should not be more than 75% of the current free cash flows. So we want to be making sure that at least 25% of the free cash flows can be retained back into the business in order to grow its top line. And rule number 3, since dividend is the main criteria for this portfolio, we want to be making sure that the company is increasing its dividends over the past 5 years. And if you want to be on the more conservative side, you can look at the growth rate for more than 10 years if the company has been growing its dividends over the past 10 years. And rule number 4 is our buy criteria. So we only want to be considered buying a company if the current dividend yield is more than the 5-year dividend yield average, so that we know that we're buying the company at a bargain price or when they're on sale, literally, right? Now let's have a look at Urbn Outfitters, URBN. Okay, Urbn Outfitters, we can see that the revenues has been increasing. The free cash flows have dropped from $241 million to $56 million. But you can consider, since it's a mall retailer, it is down at the moment because of that. But even if you were to look at the 10-year projections or 9-year projections, the company hasn't increased its free cash flows. The growth is pretty low in terms of its free cash flows. Even though it doesn't meet our dividend portfolio, we can still see if it meets our value portfolio. Okay, URBN. The return on invested capital, definitely above 10. And the minimum that I could see was back in 2018 when it was around 8.28. So this definitely meets our criteria. The revenues needs to be positive. Yes, it does meet this criteria as well in terms of its free cash flows. Now let's see if it has a strong balance sheet. So Urbn Outfitters, we can see that the total long-term debt is around $120 million. And the current assets is basically the amount of assets, the assets that can be converted into liquid cash within the next coming 12 months. It has around nearly 100 times more of the long-term debt. And if it wants to clear it off, the management chooses to do so, they can clear it off instantaneously, right? And as a result, since this company doesn't have a positive price to earnings multiple, earnings per share is a negative. We can't calculate or project the values by using the intrinsic value calculation to project 10 years from now. As a result, I wouldn't be too concerned about this and looking into consider buying the stock. I understand that there are a lot of future prospects. There's no upside to it when it comes to this checklist perspective, right? We want to be investing in companies that have a really good potential and we can make a really good return on our investment, at least 15%. At this current trend, we can't be sure whether it can profit from its earnings per share, knowing that the next 1 year or so, we don't know what the future entails. And even if you were to look at the growth projections for Urbn Outfitters, URBN, we can see that the company might grow at 9.31%, but the limitation of this checklist or this particular spreadsheet is that we cannot project the values for negative numbers. As a result, I wouldn't be looking too keen into investing in Urbn Outfitters. So Luke Lango is a market analyst for Investor Place. He has been professionally analyzing stocks for several years, previously working at various hedge funds and currently running his own investment fund in San Diego. A Caltech graduate, Luke has consistently been rated one of the world's top stock pickers by various other analysts and platforms, and has developed a reputation for leveraging his technology background to identify growth stocks that deliver outstanding returns. Luke is also the founder of Fantastic, a social discovery company backed by an LA-based internet venture firm. As of this writing, he did not own a position in any of the aforementioned securities. So don't get disappointed, guys, as I can't remember who said this though, but Peter Lynch said that for every 100 stocks that you go over, you will find at least 1 or 2 companies that are worth investing. So this is just part of our grind. We just need to start reading the articles, analyzing the companies. Hey, eventually we might come across some companies that we can invest in. That's just a part of the hustle. So if you have stayed around till this end of the video, I really appreciate it, guys. And full disclosure, this video is for your education and entertainment purposes only. There is no guarantee that you will earn any money using the techniques and ideas mentioned in this video. This is not financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So I really appreciate you guys sticking around. If you guys feel like being amazing, make sure that you smash the like button, subscribe, and turn on the bell notification icon so that you can get notified as soon as we post these videos. And until next time, catch you in the next video. Peace.